Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're really well, that you had a fantastic weekend, and this week is being very kind to you indeed. I'm sounding very chipper, aren't I? And that's because actually things are feeling a lot more positive than they have done over the recent weeks and months. So that really kind of leads nicely into what we're going to be covering off this week. So we've got an update on our lender pricing, what's been happening there. We're also going to touch on what's been going on with swap rates as well. We're going to talk about some changes to lending criteria. So as well as lenders looking to try and price things down as much as they possibly can, while obviously maintaining a kind of profitable angle to their businesses, lots of lenders are actually revisiting their lending policy and trying to kind of cast open their nets to try and be able to help more landlords in terms of their mortgage finance. That's really positive. We're also going to be sharing with you some thoughts about what's going to happen between now and the end of the year in terms of interest rates and inflation. I think actually we're able to take a kind of longer term view to take you into 2024. We're at that point in the year now where we can start doing that. That's really useful in terms of you thinking about your financing structures and also your investment decisions coming up. And then finally, we're also going to touch a little bit on how the news that came out today is Tuesday, incidentally, how the news about wage growth and employment status is going to be potentially impacting base rate as well. So lots of good stuff to cover off this week. Okay, so let's kick things off with what the lenders have been up to, and it feels like these guys are really back in business after summer break. So first of all, just to give you a bit of a lie of the land in terms of swap rates. So 2-year swap rates as of 9 o'clock this morning, 5.248%. 1 month ago, they were at 5.624%. So they've come down by a fair amount there month on month. Now, 5-year swaps, 4.631. It's nice to see something with the 4.6 rather than the 4.7s and 8s and even 5s that we've been seeing over the recent months. 1 month ago, 5-year swaps were at 4.853. So again, a reduction of just over 0.2%. So I feel like things are kind of remaining fairly staid. Things aren't bouncing around anything like they were in previous months, and actually things are on a kind of, a fairly slow, but it is a downward trajectory nonetheless. And I think this is really inspiring confidence in lenders in terms of how they price their product set. So because of this, now what we're seeing is more lenders start to reprice downwards. So just very briefly, in terms of who we've seen bring their rates down in the last week, first of all, we've seen NatWest, who have reduced their rates by up to 30 basis points. So 5-year fixed rates with these guys now from 5.39%. So we can see we're starting to get into the kind of numbers, and incidentally, that particular product has a flat arrangement fee as well, so there's no crazy 7% fee attached to it. So the kinds of numbers where actually it starts to feel a little bit more comfortable. NatWest is a lender, very vanilla. They can accept up to 10 buy-to-let properties in the background, no minimum income requirement, no limited company structures, standard properties. But actually, their pricing is competitive, their service is pretty decent, so a really solid offering from them. Now, Shawbrook, interestingly, have added 2 and 10-year fixed rates to their product set. So previously they were only offering 3 and 5 years, now they've got 2 and 10 years as well. 2-year fixed rates from 6.69, 10 years from 6.39. I did start me thinking as to whether there's kind of a space in the market for 10-year fixed rates at the moment. I think to retire in over 10 years right now probably wouldn't be something I would personally look to do, just because I do think that the direction of travel is going to be downwards. But actually, I know quite a lot of people have been saying, God, that 5-year fixed rate that I took out 5 years ago, I wish I'd taken a 10-year fixed rate, And there is a lot to be said for not having to refinance too often, because invariably most remortgages do cost us something, whether it's an arrangement fee, whether it's valuation and legal costs in addition. It does vary, but actually if you can get a really good rate for 10 years and you're willing to commit to having a mortgage for 10 years, you're not going to sell the property off and repay the mortgage during that time, because not all buy-to-let mortgages are portable, I hasten to add. Actually it could be a really good idea. So good to see Shawbrook kind of coming back into the game with those kinds of offerings. You guys will know from the videos previously, Shawbrook is a kind of challenger bank. It's more of a commercial lender that does buy-to-let. So these guys are good at things like unusual ownership structures, lumpy HMOs and multi-units are really the large ones, and slightly more the kind of more rich, quirky stuff, I would say. You wouldn't certainly go to Shawbrook for a buy-to-let, straightforward property owned in personal loans. We've only got one buy-to-let in the background. That's just not going to be kind of for them. You could do much better pricing elsewhere. Now, we've also seen MT Finance reduce their rates by up to 0.15%, so pricing here is now from 6.2. Again, we talk about MT Finance quite a lot at the moment because they seem to be repricing fairly regularly, so specialist lender, so they can do individual lending and limited companies. They can take a view on slightly more complex structures, so layered companies would be a good example of that. And they can do HMOs and multi-units as well. One of the things I really like about MT Finance is the people that actually are running their buy-to-let proposition. Really experienced guys. If we've got a case where it's a kind of a little bit left of centre, so maybe a slight bit of adverse credit, for example, these guys are very happy to pick up the file, really try and get to the bottom of what's gone on and see whether it's something they can help with. So we really appreciate lenders who are able to take proper commercial decisions on their lenders. Now, we've also seen TSB reduce their rates by up to 0.5%. I think these guys win the award for biggest reductions this week. They're pricing now from 5.79%. When we talk about TSB, think about NatWest, so it's the same kind of principle. Straightforward transactions for straightforward ownership on straightforward properties. Molo have reduced their rates. Their pricing is now from 5.45% even. Now, Molo are a lender who does limited companies, HMOs, multi-units, all that kind of stuff. Very, very good lender. They use technology quite aggressively in terms of their underwriting, so their application process is generally quite frictionless. Actually, they're quite nice to deal with from that regard, for sure. And their pricing has just come down, so they're looking a lot more competitive as well. We've seen the Mortgage Works release their rates by up to 0.5%. So 5-year personal products are now from 5.14%, and the limited company pricing is from 5.49%. These are certainly one of the institutions who's decided to embrace the low rate, high arrangement fee model for the time being at least. So those rates that I'm quoting will come with the percentage charge sort of lumpier fees. And finally, we've seen Foundation Home Loans, and actually I stand corrected, topping the table with the size of their rate reductions. They've actually dropped their rates by up to 0.9%, which is massive, isn't it? So their pricing is now from 6.59%. And Foundation Home Loans are a specialist lender, so limited companies, large portfolios in the background. They can also lend to individuals as well, HMOs and multi-units. So they've got a really solid offering, but more on them in a moment because they've made some criteria changes which are quite exciting that I'm about to share with you. So in terms of actually lender repricing, a really, really positive week. It's good to see things coming down. In terms of what we expect to see going forwards, and again, I know I said this last week, there's been a lot of chatter in the press with regards to interest rates coming down. You know, I think if HSBC drops its rates, it kind of almost makes headline at the moment. And I do think we are going to see a continuation of this, but really it's going to be very, very reliant on swap rates. And this is for those lenders who are lending from the capital markets. For those lenders who are lending off balance sheet, so those who have savers money that they're lending back out to, don't forget that they're having to pay a return to their savers. There's a lot of pressure on these guys to increase the savings rates. So if they're paying these guys more interest for saving their money with them, that means they have to pay for that somehow, and that means increasing the cost of borrowing. So I think actually one of the kind of expectations I have for pricing going forward is those kind of vanilla lenders, so Santander, Lloyds Banking Group, NatWest, those kinds of people that you find on the high street that you would save money with. The difference between their pricing and the specialist lenders, so your Kent Reliances, Keystones, Paragons, those who are more exposed to the swap rate market, you will see their pricing margins come very close to each other because the cost of funds on the money markets is coming down, whereas the cost of funds for those lenders who lend off balance sheet, they're having to pay their savers more money, so their costs are actually starting to increase. Okay, and as I mentioned a little while ago, we've also seen some changes to lending criteria, which is always quite nice. So first of all, BM Solutions have introduced what's called top slicing, also known as income-backed buy-to-let, and I'm sure there are some other kind of industry terms. We're very big in the mortgage world at using jargon, and we seem to have many, many expressions for the same product, but essentially top slicing. So what that means is that if you apply to a lender, and the standard rental calculation is not working, what they have the ability to do is then look at your own personal resources to see if you can afford to kind of top up the shortfall. Now, lots of lenders are doing this. More and more have gone into it with the current environment that we're in, where the rental calculations are much more challenging to reach. So it's great to see BM Solutions have gone into this. Is it setting the world alight? Absolutely not. How generous is their top slicing? Genuinely, I don't know. They've only launched it in the last couple of days and I haven't had a chance to use it yet. But it's great to sort of, I think, really just illustrate to you how lenders are really kind of going and looking to challenge the status quo of what they're prepared to do and actually go into things which have been in the market for years and years, like literally years and years in the case of top slicing, and bring it to market, because they're actually really working hard to try and support landlords in this sort of more challenging time at the moment. Now, we've also seen Molo make a change to their background portfolio limit. So they're now saying they can accept up to 50 mortgage buy-to-let properties in the background, no limit to unmortgaged properties. So that would cover pretty much 95% of landlords, I would say. So well done to Molo. Now, Foundation Home Loans, as well as dropping their rates by 0.9%, they've also really kind of gone to town on their lending criteria. They've really come out with a whole new load of products which are quite exceptional. So what they've done is they've made some changes to their criteria, and the changes that I'm going to describe to you come with a specialist range of products to match properties that fall into these scenarios. So first of all, they've released an extra large HMO product, which means that there is no limit on the number of rooms in an HMO. So anything 9 and above would fall into this category. So no limit on the number of rooms in an HMO. They're also now able to lend on semi-commercial properties. That would be a mixture of a commercial property and a residential as well. And it could be a shop with a flat above, it could be a shop with 20 flats above, and any of those kinds of permutations that you can think of. Now, the key kind of requirement here is that the residential parts must be the equivalent of at least 60% of the overall value of the property, and the rent from the residential parts must be at least 60% of the overall rents from the property. The third thing they've done is they've also introduced a proper holiday let offering now. So what they've always done is they'll do holiday lets, but what they would say is that the rent they will use to determine affordability would be based on a notional AST rental income rather than the actual holiday letting income, which would be much higher. What they've actually done now is introduce a proper holiday let product where they can look at the actual holiday let income, which means it would drive up the amount that you could essentially borrow. And what's really nice here is that you can start to combine all of these things together. So you could have a semi-commercial building which had a super large HMO as part of it, which you were then going to rent out on a holiday let basis. I don't know if that would work in reality, but you can kind of get the gist of what I'm trying to say. So really well done to Foundation Home Loans for getting these all over the line with their credit team. I think for lenders, it's always very hard to bring in large changes like this because it's a total change on credit appetite. So it's really great to see that Foundations have really kind of picked up their rule book, tied it up, and come back afresh with something totally new. Okay, now I was driving to work this morning, and on Radio 4 that I listen to every day because I'm of that age, it came onto the news that the latest figures from the ONS had come out with regards to wage growth. So regular pay, excluding bonuses, rose by 7.8% in May to July compared to the same period last year. Now, interestingly, inflation rose at the same pace over the same period, which means that essentially people's pay, the value of people's pay, is no longer falling. So this means that earnings in cash terms continue to increase at a record rate outside of the pandemic affected period. Now, this is obviously a very good thing for people if you're looking at kind of how stretched people's finances have been feeling, just essentially doing basic stuff like your food shopping. But this could have a detrimental effect on inflation, because obviously if people have now more money to spend, they can go and sort of essentially go out and spend more. So this could have a negative impact on inflation. But for now, that feels like some really nice news. The other thing that was quite interesting is that employment has risen to 4.3% in the 3 months to July, and that's up from 4.2%. And job vacancies have fallen to below 1 million. Now that's still 180,000 more vacancies available than there were pre-pandemic, but actually what it certainly feels like is that the employment is starting to creep up. The number of job vacancies is starting to come down. So actually things that the market is kind of really starting to get a little bit more squeezed now, and things are really kind of dampening down, which will conversely go in the favour of how inflation starts to behave going forwards. Okay, so keeping in mind all of the things that I've just told you about swap rates and inflation and all that kind of stuff, I read an article last week, or earlier this week rather, which was very, very interesting. And it's talking about Deutsche Bank's view on the market and what they think is going to happen. So essentially what they're saying is that while the government has pledged to halve inflation by the end of the year, and the latest forecast from the Bank of England's MPC suggested that we'll be at 5% by December 2023, Deutsche Bank's economists are actually more optimistic, saying they would see the CPI slowing to 4.6% in 3 months' time. So that's 40 basis points below the official forecast. Now, what I found quite interesting is the kind of commentary that sits around this. So forgive me that I'm going to read this to you, but I'm actually quoting something here. So a chap called Sanjay Raja, who's a senior economist at Deutsche Bank, wrote that while August CPI will almost certainly bump up due to higher pump prices and alcohol duty, it will remain firmly on a downward trend. Another drop in energy prices will bring CPI lower in October, and dual fuel bills will fall by 7%. Food prices are starting to normalise with plenty of downward momentum in the pipeline. Core goods inflation is now matching modelled forecasts, giving falling import price pressures and PPI pressures. And we expect to see some downward momentum in things like catering prices as firms' food and energy bills look less worrying than 1 year ago. And he added this is important as easing inflationary pressures will give the markets more optionality to price in more rate cuts over 2024 by the end of this year. So what they're essentially saying is that they don't think that we're going to be at 5% inflation by the end of this year. They think we're going to be even lower. Now, what they've gone on to do is then talk about their predictions for base rates. So what they said is that their predictions had included 2 more hikes, so one in September and a further one in November, but there are further doubts around their call. So what they're now suggesting is that it might be that we see a further increase in September, and you never know, that may actually be the end of it. So there we go, hopefully a slightly more positive tone than we've had of recent weeks and months. My general sense is that actually when I'm talking to my clients, they're feeling slightly more optimistic about things. I did actually receive the Mortgage Works buy-to-let barometer, which is where they survey landlords and their kind of feelings about, I always call it landlording, I don't think that's a word, but anyway. So I'm going to share that with you next week. But definitely when I'm speaking to my clients, I'm certainly feeling a kind of sense of optimism. They kind of feel that we're almost over the hump of the base rate situation. Fixed rates are now starting to come down, and it feels more sustainable this time than when we saw it in the spring. The other thing that's quite interesting is that Hamptons have been releasing lots of data at that time of the quarterly cycle where we start getting a wash with lots and lots of data. And Hamptons are saying they're expecting rents to increase by 25% over the next few years. So a lot of our clients are kind of saying, well, look, do you know what? I appreciate interest rates have gone up, but actually house prices have softened. I can pick up a property for thousands of pounds less than I would have paid for it last year. My rents are going to continue to raise, and yes, the interest rates are higher than I would like, but actually it's a return to kind of essentially normal lending rates, or we're on that sort of journey to get to that point anyway. So a lot of investors actually are feeling fairly, I wouldn't say ebullient, but they're feeling more positive than they certainly have done over the last few months. Thank goodness, actually. And that really kind of is a good way to finish this, I think, on that positive note. So as always, if you did have anything you wanted to have a chat about with us, you can give us a call 0345 345 6788. Or have a look at our website. You'll find an absolute abundance of information. Have a really fantastic week. Have a super weekend. And I'll see you again, same time next week.